pioneer of technical analysis in India, only on ET Now.
You're watching the FNO show right here on ET Now. A quick disclaimer. Please be sure to consult with your individual financial advisors before you take any positions in futures or options, because while you may make windfall gains in your leverage positions, you can also land up losing a lot of money. Dr. Narayan, yesterday, good enough. We did take a call spread strategy, which is worked out well this time around. But what's your own assessment of the intraday trade that we saw panning out on the Nifty, that brief decline that we saw post the GDP numbers, and then a V-shaped recovery? What is that indicative of?
Well, it clearly indicates that people have been able to take the bad news in their stride, which is something very positive, because we always look at the market's response to news rather than the news itself as the key indicator of how the sentiment at the moment is leaning towards. So I would say that the pretty swift recovery post that hit we saw immediately after those set of fundamental numbers is clearly indicating the fact that the market is more in a mood to recover from its recent trough of earlier in the weeks, and therefore this particular rally should probably continue some more. It has, and if you look at the breadth, I think it's reasonably well placed. You have leader stocks which are leading right from the front, as they should if a rally has to have more legs. And any among the leaders that you're seeing as a loser is mainly owing to some amount of profit taking and not really owing to any fresh selling. So I think all in all, I would say that the whole rally has some more legs to run on. And I would say a figure well above 5,000 seems to be certainly on the cards here.
A figure well above 5,000 seems to be on the cards there. Dr. Narayan, yesterday we also had the call ratio spread with you. Today, what is it? Do we do anything new? You've got a short straddle strategy once again, but unlike Mitesh, your strike is 100 odd points lower.
Yeah, it's the same strategy, same logic, same everything like Mitesh described. Only the strikes are different. I'm using the 4900 because, I'm seeing that in the hourly charts also the, index may have actually come off the lows, but it's yet to flash a buy signal. So I'm just leaning in the direction of a lower strike. But as otherwise, the two strategies that we are describing are fairly indistinguishable from one another. The premiums are very similar. 260 odd rupees is what you will receive as the inflow of premium for a 4900 straddle. And similar to what he said, I am also looking at unwinding this maybe by Monday, Tuesday for about 190, maybe 200 odd rupees. So shrinkage of volatility perhaps, and this erosion of the option value through theta. These are the two things that we are looking at with the short straddle strategy. We already have on a short strangle, which after having booked some loss in it by shifting the strike down, we still were retaining about 125 to 130 rupees. Now that has shrunk down to about 115 rupees. This is the 47.51 strangle. And we have the call ratio spread, which we initiated at a cost of about 30 odd rupees. And that's trading now at about 37 odd rupees. So we are making a little bit of money here and there. So more or less, I think both those strategies to be held, and this new one could also be initiated by those who are sort of listening in today.
All right.